everyone. Welcome to DCG Market Insights, where myself, Erik, and Marcus discuss state of the market. Marcus is our market analyst expert who has his finger on the pulse of the latest market trends and conditions. So we want to bring you professional perspectives and unlock what are the factors at play, and what does this mean for your business, and how can you best position yourself for health in these financial times. So Marcus, tell us what's going on in your world.
Yeah. So, there's a lot of debate right now, depending on who you talk to. Some people think the economy, we're in a new bull. There's going to be what's called, and you probably may have heard about this if you pay attention to this, called a soft landing or no landing. And then there's others thinking, it's the apocalypse. So, which one of those things, where do we fall in that realm? And so when I look at things, one of the things I see is we are very much in what's typical of a late cycle of an economic cycle. So typically you have, each cycle, you have a beginning phase of the economic market where it goes up, then you kind of have a peak, then you have a slowdown, and then finally you hit the recession, and then it kind of recycles that through. And, when we look at some of that there's some telltale signs tangibly that we're in kind of that late cycle where things are starting to slow down. One of the things that I look at that kind of tells that tale a little bit. Let me just share this real quick. So if you look at this screen, for example, you've got the returns, and this is the returns of the Russell 3000. What the Russell 3000 is, for those that aren't familiar with that, and if you're not an investor, you probably wouldn't be, is it basically, in essence, the entirety of the stock market. So this is all the companies basically mashed all together. It's high 90 percentile. If you look at this chart, what you'll notice is at the bottom here, to kind of where we're at now, we're up 13, almost 14%. That's the move from the index off to the low. The actual move, if you do the average of all stocks, is only 2.7%. And then on the median of all stocks is actually down almost 3%. And so what you see with that is we have most stocks are actually not recovering because of the different things that are going on within each company. But there's a handful of stocks that are being called the Magnificent Seven that are actually carrying the market itself, and that's going to have an impact. So we're seeing kind of a slowdown in other places. This is that last gasp of the economy, if you will. One of the things that actually came out recently, and let me pull this up, because this is something that probably hits at the heart of a lot of our clients.
What are those seven? You said, what was the name that you?
Oh, the Magnificent Seven. Well, okay, so it's like Facebook, Apple, or Meta. Facebook's called Meta now, but Meta, Apple, Tesla, Google, NVIDIA. Basically, there's these massive mega cap companies, and they are leading the vast majority of the returns of the market. So that's why the market looks like it's doing very well when your average stock is actually hasn't really recovered or participated in that recovery from the market. So those companies are kind of pulling everything because they're so huge. If Apple goes up 3 or 4%, that has a massive weight on the lift to the market. And so that's where you see some of these things break down. And you can actually see what's actually going on. But if you take a look at this kind of tells a tale as well. So this is the manufacturing index. This gray area here is whenever there's a recession. So you can see from this chart from 2005 forward, you've got one recession here. This is obviously 2008 recession. And then you have this little blip here, which was the COVID time period. But you can see this moves around over the years. But what you really have going on is whenever you have these massive drop-offs, meaning manufacturing is in a recession, it's losing, it's shrinking. You're having a reduction of manufacturing. You get recessions. I mean, look at the line when you drop below kind of here, it's a telltale that you're about to have a recession. And then look at what's happening right now.
So there's a dip in manufacturing that's happening right now.
Yeah.
In the middle of it.
Yeah, we're in the middle of it. It's been going on for a while. What's been holding things up is really the tightness in the labor market. So there's a lot of tightness in the labor market. Labor market is historically one of the last things to go, because if you're in a good market, so like a good economy, and I forget the stock market, I'm talking about just the whole market itself as far as the economics go. If you're in a good economy, and whenever you have a good economy, a telltale sign of a good economy is you have a low income, you have low unemployment. Okay, well, you as a business owner, what does that mean for you? It's really tough to find employees, right? Because there's not that many out there because everyone's got a job. So you're trying to scramble and pull in people and do whatever you can do. Well, as things begin to slow down, what's the last thing you're going to want to pull the plug on? An employee, because they were so hard to get. You're like, oh, I don't know, maybe these things are going to turn around. So the unemployment's like one of the last things that drops whenever this actually happens.
So the manufacturing volume, we're at one of the lowest points that we've been at since when?
Well, that chart goes back to 2004, so it's not counting basically the 2000 recession that happened there. So you're going kind of forward in time from there, but it's pretty consistent as you go back. Whenever you dip down into negative prints into the manufacturing, especially if it stays down there for a while, it's just one of those indicators saying, okay, something's going to happen. Now, these indicators are not instantaneously. The United States economy is a massive economy. It's not one thing isn't going to make it stumble. It's going to start to move, and then it eventually goes off. There's actually a really good telltale. Let me pull this one up because this will be really interesting for you and for our clients.
And how is that chart created? Meaning, how are they measuring the actual manufacturing output?
So that's done. This is done by that in particular is actually done by the Fed. So this is a government released report. So this is not anything that an individual is putting up or anything along those lines. This is something the Fed actually goes out there, surveys all the places, sees what the productions are, and they come out with it. Now they may tweak it, and say, hey, we made a mistake. We're going to nudge it up here. Or revision is what they call it. And that happens with all of them, all the different measures that the Fed does measure. But it's
what was the x-axis on that chart, that manufacturing chart?
Let me go back here. So, let me stop. I'll just re-pull it back up. So here you go. So essentially what this is the percentage of manufacturers showing growth in the report. So the higher this is, that means the manufacturers are saying, hey, we're making more product. We're doing more of whatever it was we were doing than we were just previously. Okay. So when you get down here, this is saying there is no growth, no production growth, anything along those lines. Does that make sense?
Yeah.
So these companies, the companies that they survey are saying, hey, we're not having growth.
Right.
Once you get down here, what they're not saying is, and they're not asking this, but are you shrinking? Well, obviously, if you're not experiencing growth, what's happening? You might have some to be exactly at the same, but more than likely you're negative.
Yeah.
So that's where you've got as far as that goes. Let me show you this. This is another telltale. It kind of shows that lag, if you will. So this is the yield inversion. So what a yield inversion is this is whenever the short-term lending on treasuries, the yield, so the return that an investor would get is greater than the yield that an investor would get buying a longer-term treasury. So for example, 2-year treasury is paying 5%, but a 10-year treasury is paying 4.5%, making up those numbers right now. That would mean you have a negative yield of 0.5%. So a yield inversion would be 0.5%. Okay. So what this goes back all the way to 1972. So this is a lot of data. And what you see is whenever you have this line is your zero, whenever you dip into this negative inversion, meaning the short-term rates are paying more than the long-term rates, you get these grayed out zones, which are recessions. So here's all the recessions we've ever had from 1972 forward. And what you notice is there's always this negative yield inversion. Even right here it was a barely one, but you got that negative yield inversion. And now what happens now, of course, this is spanning a very long time period. So the point between going negative to actually the recession, that can be anywhere from a year to 2 years. It takes a long time for these things to actually impact things. Now, when you look at it, we are now negative yield inversion because here's we are, and this is a little bit dated. This is again from the Fed. So
can we circle back on what the yield inversion means, just to
simple
our users?
Yeah. So simply what it means is the short-term lending, what the treasuries will pay, or what the Fed's able to borrow at, is higher for the short term than it is for the long term. So in other words, put it in layman's terms, let's say you were going out and you're buying either a car or a house. Well, what rate's lower when you go out and buy a house? When you pay for a house, is a 15-year mortgage higher or lower than a 30-year mortgage rate? It's lower, right?
No.
Okay, that's a normal yield curve because the longer I go out, the more risk I'm taking, so therefore you got to pay me more. With a yield inversion, everything's flipped on its head. So you have the short term. So in this case, in our example, the 15-year mortgage, you would pay 5%, and then you can go get a 30-year mortgage and only pay 3%. Well, that doesn't make any sense. And that's what's going on. The bond market is telling us something that's going on. The bond market is way bigger than the stock market. And so it's telling you something in advance. Now, we've been negative for quite a while, and we're starting to uninvert now. So that thing is starting to move, and that's typically a sign when the recession is going to hit, is when you start to see the yield curve uninvert.
Yeah, we look at that chart, there was 6 examples in the last 100 years where as soon as the yield curve inverted, not as soon as, but like you said, it could be 2 years, there was a recession.
Yeah. And when you have that actual, when it occurs, it's like a clock ticking. You don't know exactly when that bomb's going to go off, but it's a clock ticking. It's going to happen. It's just a function of when, especially when, and this is one of the stats that you don't usually get 100% of, when the Fed raises rates into a yield inversion, 100% of the time, it's led to a recession, historically. Now, does that mean it has to be now? No, doesn't have to be, but am I going to bet against 100%? Or for our clients, would you want to prepare your business in the event of a recession and weather that storm better and be safe just in case a recession comes in? Hey, if off chance the odds are wrong, 100% doesn't turn into 100%, and that doesn't materialize, I'm okay too.
How would you describe a recession?
So a recession is where you have typical recession is defined, generally layman is 2 quarters in a row of GDP shrinking. So gross domestic product going down. That's generally layman's terms. The Fed uses some other formulas and other things to come up with it, but they're very backward looking. For example, in the 2008 recession, when they finally looked back at it, the start date of the recession, they started the recession at a time when you look at the Fed's notes and what they were talking about, they said everything was fine and everything was good. So in the moment of the recession, where the recession was already happening, the Fed didn't recognize it. It was only when they looked back and they said, oh, now we see what's going on. So technically, there's a lot of factors that go into it, but more or less what generally the financial public looks at is when GDP has 2 consecutive quarters of negative growth, you have a recession. And when you think about things, it's not that hard to think that that's something that's possible. When you look at basically since 2008, we've had very low debt and our very low borrowing costs. So you could go get interest rates at exceptionally low. And then, of course, when COVID hit, interest rates basically fell to zero. Treasuries were yielding almost nothing. You could go globally, and like Germany, for example, had negative 10-year treasuries. Their debt, they were paying a negative rate, meaning you gave them money, they paid you nothing, and at the end of that 10 years, they would give you back less money than you gave them, which makes no sense, but that was what was going on. And when you have that, what does that encourage companies to do? Go get into debt and leverage, right? Because the cost of money is nothing. So my rate of return can be anything I want it to be if I can go get money cheap. But now lending is different because now treasuries are 5%. You've got lending that's going to come in, and these companies are going to start to have to pay a higher debt load, with their debt. They're going to have to refinance that debt. And when that debt gets refinanced, that's a much higher cost. And so there's going to be some business models that don't make sense now. There's going to be businesses that go under because in a zero interest rate environment, it makes sense to be in business. In a 5-6% rate, you can't do it.
Yeah. So how would a small business prepare for this?
So I think that's where you want to look at. This is where, and this goes to DCG and kind of what we do, is talk with your CFO, your fractional CFO. Talk about, hey, I'm seeing these concerns out there. What can I do to lean my business? Like that's where your CFO, your fractional CFO comes into play. And you can start to look at, okay, how can I make my business run as efficiently as possible? You can't control recessions. It's a natural part of an economic cycle, and it's not anything to be afraid of, but it's something that we need to recognize and say, okay, now's the time to start running more lean than what I need to do. And one thing that our businesses that we help need to recognize also is it's also going to be harder to get those lending and loans. If one of our customers has, and they're wanting to refinance and things, that's something that's going to be difficult. For example, let me show you this. This chart is the lending tightening standards for commercial loans, basically. So business loans. So in essence, the higher this chart, this line goes, the easier it is to borrow money. The lower it goes, the harder it is to borrow money, or the easier it is to borrow. Reverse that. The higher it goes, the tighter the lending standards. The lower it is, the easier it is to borrow money. So when you look at when times are good, so this goes back all the way to like 1990. When you look here, times are good, lending is easy. Lending standards tighten, meaning people can't get money as easily. And what do you have? A gray out box, that's a recession. Again, lending standards loosen up, economy's improving, lending standards start to tighten up, and you got another recession right here. This is 2008. This was the dot-com blow up, 2008 recession. Lending standards spiked right here. Of course, this was COVID, and they immediately loosened up because it wound up not being as bad, and the Fed dumped a bunch of money in the system. But then look at what's happened now. We're right back up here with the lending standards. What that means is banks are going to you're going to have a harder time getting money from a bank, money for your new business, money to refinance a business. And when you do have that refinance, it's going to be at a higher interest rate. So this goes back to that running lean.
Yeah, your cost of capital is going to be higher. Well, that's great advice. Definitely in the spirit of, running lean, so that if you get into a pickle, you don't have to rely on debt. You're able to your business is cash flow positive.
Well, and that's one of the things that really, I think, separates DCG from, say, for example, because I know we're sending this to clients, but we're putting it out there for people to just listen to that maybe are prospects, not clients, things of that nature. This is one of the things that is beneficial is when you work with a company like DCG, you're able to offload that finance department. And so when you do that, it's able to cost save and cut costs and make yourself more lean. So for companies that are people that are out here maybe listening to this that are not, say, DCG clients or have their own office of finance and things, that's something you may want to look at. You can eliminate the need for internal accounting, build efficiencies into your business, get CPA professionals to help you with your business, and cut the cost of that all at the same time. Helps go through this process.
Yeah, well said. Any other last thoughts to add?
No, I think that's really it. As we go through these meetings, and have these more frequently, I think what we'll see is, as time progresses, we'll see things get a little worse, but then they'll start to get better. And that's when we can take advantage of those things and be prepared to maybe expand that business when it starts to grow. And that's some of the things that, again, fractional CFOs do for our clients and for prospects out there looking.
Sounds good. Thanks, everyone.